my time, you are I want.
Okay, g'day, Rudy here. Looking at a Motley Fool article. Forget CBA's term deposits and buy these dividend-paying ASX ETFs. Okay. Now I'm going to work off the premise that if you're looking for income, you're not really looking for growth, or it's a secondary or thirdly priority, and you want income, but you want to preserve your capital. That's the thesis I'd be working off if I'm looking at if I was looking at that type of investment as an investor. You've already got your money, you just want a good income. Alright, so let's have a look at VHY. Okay, VHY. Okay, so VHY's in an uptrend. In my view, it's going to form a rounding top, so it's not going to take out these highs. So I'd say there's no capital growth from here, and it's going to come back down here over time to 70. So there's a bit of capital loss there in the medium, say over the next year. So there's a 5% trailing yield for a risk of capital loss. No thanks. Okay, next one's WiMAX. WiMAX it's a really good one. They talk about, so it's got a trailing yield of 7.7%. The reason it gets extra cash is because of this covered call option. If you don't know what that is, I've done a video on this one before on WiMAX. It's good in a rising market essentially, but it's not good in a downward market because no one wants to buy the calls, so they can't make the extra cash. But anyway, so let's have a look at WiMAX. Okay, so that's why it's covered call basically means it misses out on any capital growth, but it comes back in dividends. And again, you've got one of these rounding top patterns here. So again, we're looking at capital loss in the next 12 months. Okay, so now the Australian Bank Senior Floating Rate Bond. Okay, so it's a floating rate. You either have floating or fixed. Fixed rate bonds, you're at risk of interest rates going up and down and the capital value increasing or decreasing. So floating rates takes that risk away. So, that's a tick. 12-month trailing yield of 5.5. Okay, not too bad. If we have a look at, and you see, because it's floating, it doesn't really, it's as close to a bank account as you're going to get. But obviously, being a bond, it's still at risk of interest rates movements. But yeah, I'd say it's going to be pretty steady. It's not going to go up or down. But why would you do that? Under my premise, I said in the beginning, when you can go and get 4.9% on that's a 6-month term deposit. So if you can get up in the high, so if you look around, there's lots in the high fours that you can get. So why would you risk to get an extra 1% per annum to risk a loss of capital? Alright, that's just Rudy's views, my own personal opinion. Thanks, bye.
Never waste my time, you are I want.